Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks reversing course sharply as investors are taking in a softer than expected jobs report and eyeing a Fed rate cut within reach. We're digging into those stories. It is, of course, the last trading day of the week, and there's just an hour to go until the closing bell. Stocks a bit softer here. The Dow's down about 220 points. The S&P 500, your broad gauge, is down about 0.5%. The Nasdaq down about 0.2%. Let's welcome now our Fed correspondent, Jennifer Schonberger. We also have data and markets editor, Jared Blickreed, joining us to break down the headline. Jared, I'm going to start with you on the trading action so far.
Well, we opened the day at record highs in the Dow, the Nasdaq, and the S&P 500. We have reversed that, and so you're looking at some red on your screen there. The Dow down 0.5% or 0.5%, down about 230 points. The Nasdaq down 0.25%, and the S&P 500 off nearly 0.5%. But looking at the small caps, we're seeing a little bit of green in the S&P 600 there, but just barely. And I got to talk about the bond market, where the 10-year and the 30-year, they're both down about 9 to 10 basis points. You can see the 30-year, it was almost at 5% earlier this week, now down to 4.78%. That takes some pressure off of stocks because stocks don't like that 30-year above 5%. But the question is now, is the Fed behind the 8 ball? And that's a big question because September rate cuts are getting priced in not only for 1, but 2 potential cuts. In sector action, we have real estate. It's been leading all day long thanks to those drops in interest rates. Then you got materials, communication services, healthcare, and staples all in the green. But leading to the downside, we got energy off more than 2%, followed by financials right there with it. And I should note that industrials and utilities also down about 0.5%. Inside the NASDAQ 100 real quick, we got Broadcom leading the way higher after earnings yesterday, up 9-10%. And what is good for Broadcom, not necessarily good for Nvidia, that is down 3%. Back to you.
All right, and back to that disappointing jobs report Jared was just referencing there, that certainly as Fed watchers saying, hey, rate cuts now squarely on the table. Jen, you saw the numbers. You spoke to the U.S. Labor Secretary. Jen, is a cut imminent? And what do we need to know from Washington?
Yeah, hey there, Josh. That weaker jobs report likely to seal in a Fed rate cut at their next policy meeting on September 17th, as the Trump administration yet again hammering the Fed for not cutting rates yet. President Trump posting on social media earlier today that Fed Chair Jerome Powell is yet again too late and that he should have cut rates, quote, long ago, while Labor Secretary Lori Chavez DeRemer told me this in an interview.
Jerome Powell needs to do his job and cut those interest rates now. What is he waiting for? While I'm not the economist, I can tell you this. If he doesn't cut those rates, the American people will continue to suffer. You know, the companies are investing trillions of dollars into the economy and into their workforce and into their businesses. The American people, I mean, think about this. Wages have gone up, unemployment has held steady. We're seeing, again, the investments in the American worker. Everything that the Department of Labor is doing is to invest in reskilling and upskilling, and we need that help because why? Because cheaper dollars for the American business to invest in their workforce is not happening. And why he's waiting is, it boggles my mind why, he knows the data, he knows how important this is, and if it's a political move, it's nonsense. He needs to go ahead and move forward and cut those rates.
Now, this was a weaker jobs report across the board, not just in terms of what economists had estimated, but in comparison with previous months, whether it was payrolls, average hourly earnings growth, which slowed, or the unemployment rate, which ticked up to 4.3% from 4.2%. We are now growing jobs at a rate below the break-even rate. That is the rate that you need to create jobs per month to keep up with population growth. This past week, St. Louis Fed President Alberto Musalem said he estimated that that would be somewhere between 30,000 and 80,000 jobs per month, compared with what it used to be, which was 100,000 jobs per month. And if we're growing at 22,000 on payrolls in the month of August, we're well below that. Now, it's interesting because Fed Chair Powell and the rest of the Fed had said that they really need to take the summer to see what the impact of tariffs would be on inflation. Little did they know, little did we know that the focus would shift to the job side of their dual mandate. And just 2 weeks ago in Jackson Hole, Chair Powell opening the door to a potential rate cut at the September policy meeting based on those large downward revisions we had seen back in July. And today we saw that weaker jobs report, seeing downward revisions for the month of June, job growth tipping into negative territory. Now, Chris Waller, a member of the Fed Governor Chris Waller, has been calling for a 25 basis point rate cut, though he had reserved judgment to look at this report to see if they could do maybe more, maybe a 50 basis point rate cut. I could see the FOMC coalescing around a 25 basis point rate cut. 50 basis points may be a lift for certain members on the committee, and if that were to be the case, we could see some dissents there, though it does feel like a little bit of deja vu from last year when we saw a weaker jobs reading in the month of July for the Fed to turn around and catch up and cut by 50 basis points. I said it before on our air, and I'll say it again today. It was this jobs report that was going to be the determining factor for whether the Fed cuts in September. Barring any huge surprise on CPI next week, I think that they move with a cut. I think that if you have a deteriorating job market, if it is deteriorating quickly, it's gonna snowball. And so the Fed knows that. They want to catch that right now before they edge over the cliff. Josh?
Yeah, for sure. When the labor market goes south, it can go south in a hurry. Thank you, Jen. Thank you, Jared. Appreciate it. Well, the U.S. labor market losing more steam in August, adding just 22,000 jobs. That was far short of the 75,000 jobs economists had expected. The weak report has markets recalibrating. Odds of a half-point rate cut in September are now over 10%. That's according to the CME Watch tool. Joining me now, we got Thomas Simons, Jefferies chief U.S. economist. Tom, it is great to see you. So let's get right into that jobs report. I'm curious what you make of it, Tom. You know, is this just a labor market that's cooling, Tom, or no? You see something perhaps more alarming?
So I have to say that my view on this jobs report has more or less mirrored the up and down action of the stock market today, which is that initially you see the number, it looks quite bad. Mm-hmm. You start digging into the household survey a little bit, and then you say, oh, well, you know, roughly half the number of people that dropped out of the labor force in the last 3 months came back in August. And that kind of gives you some sense that maybe we haven't hit some nasty tipping point that's going to send the labor market into some tailspin. But then you dig even deeper into the details and you find these various metrics of you know, how difficult it is to get a job after you've lost one, how unlikely it is that someone who's been unemployed for a long time is going to come back into the labor market, or how likely they are to drop out of the labor market. And then you start to see, you know, you look at youth unemployment and things like that, and you start to see, hey, this no hire, no fire thing isn't good in the indefinite, you know, and an indefinite time horizon. Like they need to come to some sort of consolidation. The labor market needs to grow again in order for that momentum to come back, both within the labor market and in the economy more broadly too.
So in terms of the sectors, I want to get your take on this. One data point that stood out to me, we know the president very focused on manufacturing. Okay, manufacturing, Tom, shed jobs for a fourth straight month. Can you walk me through what exactly is going on under the hood there?
Yeah, I think a big chunk of the manufacturing jobs we lost are actually in transportation equipment manufacturing. So I imagine that is a consequence of probably, I mean, you know, I don't want to speak to single names, but like we have one particularly large aircraft manufacturer in the country that's been having some difficulty for a while now. Same thing with domestic auto manufacturers have had difficulty in the transition to EV manufacturing. And then you combine that with difficulty in managing input costs going up potentially because of tariffs. It just all shakes out to a very difficult position, you know, for these manufacturers to be in. And then once you go down in scale to smaller manufacturers, those input cost increases are just that much more difficult to manage in terms of, you know, preserving margin.
Now, Trump did say, remember last month, of course, the data was incredible. He clipped the BLS head.
Yeah.
As an economist, I am curious. You look at the data. Do you think it's credible?
I don't think it's any less credible than it was before, I should say, right? And I do think overall it is credible. I don't mean to say some sort of doublespeak here, but like I think that it's just fine. You know, the data this month looked to me basically as, you know, high quality as it was last month. And I'm not denying the fact that there are some issues with survey collection. You know, there's the low response rates and that sort of thing. And I think there is a feeling that as so many other things, whether it's in the private sector or in government, have been modernized, digitized, just sped up, that it seems odd that we have such a difficulty in counting jobs, right? It's like, I certainly know that there's income that's withheld from my paycheck every couple of weeks that goes to somewhere in the government. They should know that I'm still employed. Like, why can't we use that data to kind of match things up, right? That's how ADP does it. So I don't see why the BLS couldn't do it either.
Let me ask you this.
Yeah.
So for investors, they look at this report, they're trying to game out, all right, what is, what they think, what you think, what does Jay Powell think? Did you look at this report, Tom, and say, okay, that rate cut is a lock?
I did, yeah. I mentioned before that I was kind of up and down, back and forth on it. My back and forth was, there's not enough here to go 50, to maybe there is enough here to go 50, right? This is a very similar situation to what we had last year when I believe it was the September data came out, like I should say the August payroll data with July revisions came out during the blackout period ahead of the FOMC meeting. And we went from like not really knowing what was going to happen to all of a sudden a 50 basis point cut in September. And everyone's saying, hey, the Fed probably should have cut in the summer, right, in June or July. I think that situation is very, very similar to what we have now as you look at the texture of payrolls for the last few months. But when we saw the June payroll data in July, it was an increase of over 100K, right? Now it looks like a decline of 14K. So I think it's not the fault of the Fed for being too late. I don't think that there's any reason that they should have said, I think this data is going to be revised down sharply out of nowhere, right? I mean, there is a fact that the data didn't reconcile well at all with a number of anecdotal reports about the economy and certain hard data series as well. Now it all kind of makes sense. So we had this big slowdown after Liberation Day. We haven't gone into a point where people are panicking and firing all their workers, but we are in a situation where the labor market isn't growing very much either.
What's the risk of a cut, Tom? And certainly a cut by 50 if your inflation is still above target. And by the way, of course, we get CPI and PPI next week.
We do. And I think that they're going to end up being more or less in line with what we've seen in the last several months. Continued pressure in core goods because of tariffs, but spread out and not all that big in any individual category. Shelter costs keep coming down. That's at risk if they start cutting rates, I guess. But I don't really particularly worry about this aspect of a 50 basis point cut or even 100 basis points of cuts from here to some target number in the future is going to all of a sudden spur all this consumer demand that's going to reduce inventories and drive up prices further, right? Like I do think maybe there is some price pass through that could happen if businesses start to say, well, I was worried about the labor market and I wasn't passing through prices. Now I'm less worried about the labor market, so maybe I'll try. But I don't think we're going to get some sort of demand-driven spiral that's going to have, responsive increases in wages and prices. And in the counter, if they weren't going to cut, if they weren't going to do anything to help the economy, and the labor market is falling apart, I still fail to see any, justification for the notion that prices are going to go ever higher when there's lower and lower aggregate demand as a consequence of the labor market.
I want to get you out of here on this.
Sure.
Stephen Myron was on Capitol Hill this week, was getting grilled by lawmakers. I did have some strategists, some economists on the show this week, Tom. Some of them did express these concerns about Fed independence, and I'm wondering, as an economist, are you in that camp?
I go back and forth on this, to be honest. I think that there are some sacred cows in economics that have been upheld for a long time that have very strong justification for wide acceptance. Fed independence is one of them. There's a number of studies that I'm sure all of these other strategists had cited that said over time these are the things that lead to better outcomes in the economy. And certainly if you compare the independence of the Federal Reserve with a country like Turkey, for instance, where the leader of the country becomes the top central banker, yes, I mean those are very obvious benefits to what we have. But that doesn't mean that what we have had is perfect. I mean, there have been some allegations that the Fed hasn't been particularly independent of politics in previous administrations, right? I think it's better now than it was, say, before the accord with the Treasury in the 50s. I'm not so worried that all of a sudden Donald Trump is going to be the proxy Fed chair and do crazy things.
Tom, always great to see you, especially on set. Thank you, sir.
Thank you.
We are just getting started here on Market Domination. Coming right up, across the pond, Google has to pay a big time to the tune of $3.5 billion. We'll explain why. Plus, Tylenol may be causing a headache for Kenvue. We're telling you why. And for Nvidia, gaming is still growing, but AI is the true profit engine we know. We'll explain how that came to be and if the tide will be turning. Those stories and a whole lot more coming up. Stick with us. Markets are grappling with a mix of cross currents as we sit here in September, a month marked, we know, by seasonal weakness. And now investors face new employment data, got volatility, and a holding pattern for a Fed rate cut. Keith Lerner, Chief Investment Officer, Chief Market Strategist at Truist, is here. Truist has more than $544 billion in assets under management. Keith, always great to see you. So we'll start there, Keith, with that jobs report we got this morning. I'm interested to get your take on that, Keith. Did it change anything for you, Keith?
Yeah, well, great to be with you, Josh. It was a clunker. I mean, if we look at the last 4 months, on average, we're averaging about 25,000 jobs a month. So that no hiring, no firing that you were just talking about in the earlier segment is really in vogue. I will say, if we look at, like you said, cross currents too. I mean, we look at initial jobless claims, that's kind of holding steady. We look at the ISM services that had a little bit of an uptick. The Atlanta GDP numbers are, steady. Credit card data that we look at looks okay. So, overall, our view is this kind of economy continues to muddle along. And I'll just say more directly to the employment. Think about, May, June, July. Like there was so much macro uncertainty. The one big beautiful bill didn't pass into July. So it makes sense to us that we saw a bit of a slowdown. But we actually think we might see a little bit of a pickup before year end.
So let me ask you, Keith, what do you think the Fed made of that report?
Well, I think as most folks have been talking today, it would cement the rate cut in September. Now we're also seeing in the Fed funds futures market, the market now trying to price in a higher probability of 3 rate cuts. But I think at this point, after Powell's speech already, and now this on top of it, it says, hey, we need to start moving forward. And we expect at least 2 rate cuts. And again, the third is on the table, depending on the inflation side, but I think they're going to start moving.
Does this market, Keith, in your opinion, does it require cuts to move higher?
I think it's more about composition. The one thing I was thinking about today, we had this really, kind of softening in the labor market over the summer months, but then we look at, the earnings picture, and there's a divergence, right? Because the earnings season we just went through was extremely strong, and it was extremely broad. And when we look at forward earning estimates, we're seeing forward estimates go up for large caps, mid caps, small caps. And so that's, a bit of a dichotomy. But so going back to your point, does it matter for the stock market? It does. But, on the technology trade, I don't think they're as dependent. I think for the rotational trade, and we're seeing that again today for things like small caps, international, I think that the rate cuts are important. And you're actually seeing on a day like today, small caps in the equal weight index actually slightly up.
So, Keith, let me ask you, as we sit here right now, I got the SPX at 6480. Are we higher by year end, Keith? And if so, what would be the catalyst to get us there?
Yeah. So to answer your question, I do think we're higher by year end. I do think we see some chop in the interim because don't forget, I mean, this market, the S&P is up 30%, since those April lows. The technology sector is up 50%. So some digestion, irregardless of this report today, makes a lot of sense to us. But I think eventually we do move higher. And part of that is as we kind of digest and consolidate some of these gains, I think what you'll see as we move into the fourth quarter, that the earnings for the technology should continue to be strong. And then as the market starts focusing on next year, but we actually think GDP estimates come up to about 2% from about 1.3% this year. Then you have more focus on deregulation, and also companies can start acting on some of those benefits from that one big beautiful bill as well. So you put that all together with some rate cuts, I think that will be enough to initiate markets moving higher by year end. But doesn't mean that it's going to be a straight line. Doesn't mean we're not going to see at least one pullback along the way.
Let me ask you, I had a strategist on this week, smart guy. He was more broadly cautious. One reason, it probably won't surprise you to hear this, is valuation. He just thinks we're too pricey here. What do you say to that?
Valuations is an interesting topic, and it's really what you look at. If you look at the S&P 500 as a whole, we're at a 22 multiple. That's saying you're pricing in a lot of good news. Now, a lot of that higher valuation is reflective of the technology sector. If you look at the equal weight S&P, you're around the 17 PE, which is around the long-term average. And by the way, part of the reason why I think the market has a higher valuation is it's been battle tested, right? I mean, how many shots has been fired on this market from inflation to one of the fastest rate hike cycles in history to supply disruptions? Each time these companies have adapted and adjusted, and the composition of the market has also adjusted over time. So yes, valuations are rich. That probably means that long-term returns are likely somewhat below average. But in the short term, the valuations by themselves aren't a great indicator for where the market's going to be the next 3 to 6 months.
Yeah, not a great market timing tool. I take your point, Keith. So let me ask you, when your clients do ask you, okay, so what are the broad downside risks, I should have on my radar? What are you telling them?
I still think, even though we think the economy is going to pick up a little bit, the softness in the job market that's flashing yellow right now. So we'll certainly have to watch that. If the Fed's cutting rates into an economy that's going to continue to slow down, I think that would be the biggest risk to the overall market. So even though we're still positive on the equity market, we still think it deserves the benefit of the doubt. We're also preaching balance. It's boring, but the 10-year Treasury yield is actually moving down today, and that means bonds are moving up. And despite all these concerns about deficits and inflation, guess what? Bond yields are actually down for the year. And on top of that, we also have been bullish on gold all year long. We just broke out of a 40-month trading channel. I think that's positive. So at the end of the day, there are risks, and you still want to have those diversification pieces within portfolios, but we're also still saying we're sticking with the underlying equity trend, and we think that trend eventually moves higher after a bit of a digestion period.
Yeah, and gold rallying, by the way, fresh record here. Keith, always great to see you and have you on the show. Thank you.
Thank you. Have a great weekend.
Now time for some of today's trending tickers. We're watching Alphabet, Kenvue, and Lululemon. President Trump weighing in on the $3.5 billion fine the European Union hit Google with over alleged anti-competitive practices in its ad tech business, calling it very unfair and saying he might be forced to act to nullify the penalties. The EU is claiming Google has abused its dominance in online ads by steering businesses toward its own platforms instead of letting rivals fairly compete. Regulators are ordering Google to, quote, bring these self-preferencing practices to an end. The company has 60 days to respond. Google's vice president for regulatory affairs says the decision is wrong and the tech giant will appeal, also adding that the decision imposes an unjustified fine and changes that will hurt thousands of European businesses by making it harder for them to make money. This comes amid broader antitrust pushback on Google, the tech giant recently winning a separate fight, remember, that will allow it to keep its Chrome search browser. Meanwhile, Kenvue is falling after the Wall Street Journal reported that HHS Secretary Robert F. Kennedy Jr. is planning to link the company's Tylenol pain medication to autism. The report says RFK Jr. will announce that pregnant women's use of Tylenol is potentially linked to autism and will also suggest a medicine derived from folate can be used to treat symptoms of the disorder. A Kenvue spokeswoman telling Yahoo Finance, nothing is more important to us than the health and safety of the people who use our products. We have continuously evaluated the science and continue to believe there is no causal link between acetaminophen using drug pregnancy and autism. The HHS is also weighing in, calling the Wall Street Journal report speculation. RFK Jr. previously said he planned to reveal the cause of autism by September. And Lululemon has been hit with at least 7 analyst downgrades in the day following quarterly results. The retailer cut its outlook for the third quarter and in the full year as tariffs and weaker demand took a bite out of sales. Truist, Evercore, ISI, Telsey Advisory Group, B of A, Oppenheimer, William Blair, and Stifel all cutting their ratings on that stock. The majority of analysts now have hold ratings. TD Cowen says the company needs a, quote, strategic pivot as the firm enters a new phase. Well, coming up, and a big compensation boost may be in the cards for Elon Musk. How about $1 trillion for meeting work goals? That could be the payday for Musk. If he delivers, we're going to have more on that story when we return. Stick with us. Elon Musk, the trillion-dollar man. Tesla unveiling an eye-popping pay package for its CEO with a series of ambitious benchmarks the company must meet to unlock the compensation and an increased stake in the EV giant. Joining me now, we got Stephen Gengaro, Stifel Next-Gen Transport Analyst, and Gautam Mukunda, Yale School of Management lecturer and author of Picking Presidents. Stephen, I'm going to start with you as a financial analyst on this panel. You, of course, Stephen, you know this company backwards and forwards. What do you just make of this pay package, Stephen? The trillion-dollar man, potentially. The targets Musk has to hit here, Stephen, they're ambitious. I mean, deliver 20 million vehicles, final tranches unlocked when the company hits 8.5 trillion. What do you make of it?
Yeah, thanks for having me. Good to see you, Josh. I as a Mets fan, say Juan Soto makes a lot of money, but this is crazy, right? when we think about this, I mean, the numbers are astronomical. The targets that are laid out, I actually think the product targets are reasonable. The EBITDA targets are clearly extremely lofty over the long term. The value creation, I mean, you're talking about a $1 trillion market cap stock right now. Our target price is $440. That's about 1.5 trillion, and you're talking about getting a market cap to like 8.5 trillion, right? So the numbers are insane. I think, from our perspective, by far the most important thing, we could talk about kind of what has gone on over the last year, but the most important thing is that Elon Musk is ultra focused on Tesla and the success of the company. And obviously there's been a lot of noise around his involvement with Doge and some people maybe thinking he was not going to be the long-term leader of Tesla. And we are ultra comfortable with him leading the company. We think he's critical to the business. And I think this incentive plan obviously puts a pretty large reason for him to stay ultra engaged in the company.
Steve, I take your point. I mean, these the targets they're wild. Although, you think back, Stephen, to the 2018 pay package, and you remember how there was a lot of hot talk back then too, and forget it, it's pie in the sky, it can't be done. But he did hit those targets, right?
Yeah, he did. And it's funny, I was just kind of taking a quick look. I mean, you hear this number, $400 billion in EBITDA. And then you think about, our 26 EBITDA number is about 17 billion, right? So you think about kind of what it takes to get to those levels. Now, I do think, right, and we still, we value the company a lot on the auto side and the robo-taxi and full self-driving initiatives. And we haven't, quite honestly, got our arms completely wrapped around sort of the upside capabilities of Optimus and the robot business. But, Elon has said, many, many times that is likely the most valuable part of the company long term. And, clearly that needs to be a big piece, of the escalation in profitability over the next 5 to 10 years.
Gautam, I want to bring you in here as well. You approach it, look through a different lens. I guess, Gautam, you have Tesla's board here. And they're thinking, you know what? We got a guy who is worth an estimated $430 billion. How do you keep this person motivated and engaged and committed and showing up to work? And this is what they come up with. What do you make of it?
So someday, Josh, I or one of my successors at business school is going to teach a case study about this board. And we're going to walk up in front of our class and just put our head in our hands and say, "I have no idea. This doesn't." Let's put this in a little bit in perspective. To hit all of these targets, to become the $1 trillion man, as you said, Elon would have to increase the value of Tesla by a factor of a little bit over 8. He already has $140 billion in equity in Tesla. That's independent of this package, plus, of course, his holdings in SpaceX and things like that. So if the board did not give him a single other share, by hitting these targets, he would become a trillionaire anyways. So the logic is not, we need to give him this to motivate him and keep him focused. The logic is that $1 trillion is not enough to keep him motivated and focused, and we have to give him a second $1 trillion to get him to this. These are numbers. You said these are astronomical. They're actually not astronomical numbers because astronomy doesn't deal with numbers this large very often. $1 trillion is way more than the number of stars in the Milky Way galaxy. So these are numbers that I think the message I would really take away from this is that the board understands that Tesla's most important product is not cars or self-driving cars or even Optimus. Tesla's most important product is the legend of Elon Musk. And to get into this, you have to believe that Elon Musk can work magic, right? And look, he has. You're not crazy if you say the guy who took the price of putting something into low Earth orbit down by 90% might be able to work other technological miracles. That's not a crazy thing to say, but it is what you have to believe.
Gautam, let me ask you this. What about those who say, in general, this at least it's the blueprint that a board should use, in that Musk gets paid if he sticks to landing. He has to hit these targets. And in general, you'll hear this argument, that's what we should be doing. We shouldn't be having situations, and we've seen these, Gautam, of course, you and I have been doing this a long time, where a CEO might just drive his company into a brick wall. Shareholders are left with the bag. At least we've set up a system where, listen, if he gets paid, if he hits the numbers, he has to stick the landing. What do you say to that?
So it's this, he's already going to get paid if he hits the numbers, right? Like, this is the key component. If he hits these numbers, he will make hundreds and hundreds of billions of dollars. And what the board has said is that is not enough. And so we need to transfer another $1 trillion of shareholder value into his pockets, because that's the only thing that will get him to focus. So Josh, I mean, look, you'd have to budget really carefully, right? And I mean, I know you'd have to make some cuts, but is there anything you couldn't buy with $1 trillion that you could buy with $2 trillion?
These are questions I'm just never going to have to actually think through. I don't think, Gautam. I mean, maybe someday, who knows, I'll have you back if I have to. Stephen, let me ask you this. Is part of the pressure the board's under here that, and we talk about this, I think I've even talked about this with you, Stephen, that Tesla is a different kind of company in that Tesla is Musk. Musk is Tesla. You'll hear this. And there's just too much risk that Musk would ever walk out the door for the company.
You know, it's interesting because when we were asked about his involvement with Doge and, you know, whether or not Elon was focused on Tesla or not and how investors should be thinking about his distractions from other areas, our view was always that Elon knows he will forever be linked to Tesla and the success of Tesla. So, you know, whether it's $1 trillion or whether it's more or less, you know, we've always been of the belief that he would be ultra focused on the company's success. But to your point, does it need to be this large? Maybe not. But obviously it locks Elon into Tesla for the very long term. You know, and as an analyst and as, you know, our clients we talk to, I mean, Elon's obviously the super critical piece of the organization. I mean, I've been asked the question a lot, like, you know, do you think the company would be better off without Tesla? I mean, my answer is no before the question is finished, right? So in our view, his involvement is obviously locked in for the long term.
Gautam, what did you make of this other proposal, by the way, that Tesla would invest in Musk's AI startup, XAI?
I mean, we're at so many different levels of conflict of interest here that there's just kind of, at this point, as I said, this is one of the many, many ways I would just put my head in my hands to my students and say, I don't know, guys, don't do this. Like this is cool. Let's back out for a second, right? Like, I couldn't tell you what fraction of Tesla's total valuation is attributed to Elon Musk, but I can tell you it's a very big fraction. Right? It's a huge fraction, because otherwise what you're seeing is a car business that isn't really doing all that well, a robotics business in an industry where Tesla is not the leading robotics company, and a self-driving car business where Tesla is not the leading self-driving car company. Like, giving them $1 trillion valuation on that is hard if you don't say Elon Musk. But so much of Elon Musk's, if that's true, if Elon Musk walked away from Tesla, the single largest source of his wealth, well, his wealth would kind of go away. A big chunk of it. He's basically saying, guys, I'm going to hold a gun to my head and I'm going to pull the trigger if you don't give me what I want. Normally, with a board that most boards would say that is not a plausible threat. And so the XAI things to me is just yet another indicator of this is a board that has completely outsourced its judgment to Elon Musk and said, we'll do whatever you want because you're the only thing that matters here.
On a down day, it's interesting, guys. I got Tesla up, and you know what? Other EV makers in the green too. Maybe everyone's excited about this $1 trillion man. Who knows? Stephen, Gautam, always great to have both of you on the show. Thank you, guys.
Thank you.
Thank you.
Coming up, more market domination right after the break.
It's an AI-dominated world now, and Nvidia's chips are leading the way, yet most people still know the company for its gaming chips. On today's Stocks in Translation, we're going to show you how the money engine at the world's largest company by market cap has shifted and why it matters for investors. First, a quick visual on Nvidia's data center, which is basically its AI business versus its gaming business. First, let's focus on the left, which covers the data center. It's a warehouse of network servers that run apps and AI, and its products are AI chips and systems for the cloud. Who's buying them? Amazon, Microsoft, Google, plus other large tech companies. They're scooping them up so they can offer AI services for businesses and even to the public sometimes at scale. On the right side, we have gaming. Think GeForce PC graphics and Nintendo console chips. And everyone from PC gamers to PC makers, both retail and online, are still paying up for these premium graphics chips. Fueling the buying spree are big game releases and new launches of the gaming chips themselves. And now let's show how big each of these two markets really are, as of Nvidia's last quarter ending in late July. That top bar here shows Nvidia's revenue or sales for its data center business, $41 to $42 billion. And you're going to quickly notice how much smaller that bar underneath is, just $4 billion. That's the gaming business, which is only a tenth of the AI business, not a subtle difference at all. And how did we get here? AI native companies, those built around AI from day one, they are scaling real revenue exponentially. Listen to Jensen tell it.
If you look at the AI native companies, last year they did $2 billion altogether. The first year of AI revenues. The second year of AI revenues, $20 billion, tenfold increase in 1 year.
Now let's take another look at data center sales versus gaming, but over time, going back to 2014. Notice how both lines track each other for years until data center in white suddenly rockets higher while gaming continues on roughly sideways. And by the way, those two lines go from solid to dotted at the right side of the chart, which represents estimates of future sales. What's clear is the gap between the two segments is only expected to grow wider as the pace of data center growth holds steady. And a quick aside, that's probably the number one risk to this stock. If data center growth slows down instead of keeping at its current pace. And here's the twist. AI is also boosting Nvidia's gaming segment. And let's listen to Jensen again.
And now what's amazing is AI is coming back to revolutionize GeForce for gaming. And this last quarter, I think we had a record quarter for gaming between GeForce and Nintendo Switch.
Think of Nvidia as AI infrastructure first and gaming second. And the feedback loop from AI makes gaming that much better. For investors, that means the biggest driver is still the data center engine, while gaming benefits from new GPUs and also hit titles. Now here's what to watch next for investors. For the data center, you got to keep tabs on the industry-wide spend on cloud AI, as well as a backlog. That's in addition to AI chip shipments and supply trying to keep up with that demand. And under gaming, watch out for new hit game releases along with new gaming chip launches, along with pricing. If cloud budgets keep expanding and shipments stay on schedule, the data center story has room to run. And if rivals press on price or if supply gets tight, watch those margins in Nvidia. So in gaming, a strong holiday lineup or a new GPU cycle could easily give the franchise an extra lift. And bottom line, Nvidia's reputation was built on gaming, but the story today is the AI factory. The charts show it, the orders confirm it, and the roadmap extends it. Tune into episodes of Stocks in Translation podcast for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's websites or wherever you find your podcasts.
The Trump administration has been pushing the drill, baby, drill mantra for more oil and gas, but our next guest says electricity is the new oil. We're navigating how to play the energy sector with the Yahoo Finance playbook. And joining me now, we have Rob Thummel, Senior Portfolio Manager and Managing Director at Truist. That firm has $9 billion in assets under management. Rob, it is always great to see you. So let's actually start with those OPEC Plus producers. Meeting this weekend, Rob, the expectation is they're going to boost output. Is that your expectation? And what would that mean for oil prices, Rob?
Well, the oil market is already oversupplied because OPEC is already bringing back a lot of production. So if they add more and really create more of an oversupply, I think oil prices will probably continue to decline. And we think for the rest of the year, oil prices could move into the 50s. So that's a great thing for the consumer. That's a great thing for inflation.
You think oil moves into the 50s?
For this year, absolutely, because the oil market's oversupplied, and that just means that oil prices are going to have to move lower. Production is going to have to slow down and until the market becomes more balanced, and that just requires a lower oil price.
Interesting. I mean, we talked to OPEC. How does the president play into this? Because we know from there, Trump. I mean, really, it's not just a Trump mantra. It's a GOP mantra. Drill, baby, drill. At the same time, of course, he would want to see lower prices at the pump. But what do you see for U.S. production?
Well, U.S. production is actually flattening out, and it's actually probably declining right now. And I think you're going to see U.S. production decline into next year as well. Once again, that's because of the low prices. And so I know that's counter to the drill, baby, drill.
Yeah.
But also remember, the administration wants low gasoline prices and we all want low gasoline prices because that helps. That's helpful for the consumer, and it's helpful for the economy though to have lower prices. It's just going to be really something that's beneficial to everyone because of the lower inflation that will ultimately result in.
I want to talk about some places where you see opportunity. What's interesting, you say it's about EIA. And what do you mean by that, Rob? You say it's about electricity and exports, it's about income, and it's about AI infrastructure. Let's start with the E, which is interesting, because you like a few here. You got Vistra, I see Cheniere, I see EQT. If you had to pick one of those in that theme, that trend, what would you pick?
Well, out of that one, I'd probably pick Cheniere because the U.S. is one of the largest exporters of energy in the world, Josh. We're going to increase exports of liquefied natural gas, and Cheniere is the best pure play way to play that. The great thing about the energy sector, Josh, is this. It's got a lot of free cash flow, and Cheniere is really the quintessential example of that. Cheniere is going to generate about $25 of free cash flow over the next several years, well, actually over the next several decades, and it's either going to pay that, it's either going to buy back stock, or it's going to basically pay a big dividend to shareholders going forward. And so I just don't think that the market is really realizing the cash flow significance of a company like Cheniere. So I think it's got tremendous upside.
Let me tell you, and then of course we have the I here. That's the income. Of course, this sector known for those meaty dividend yields. Two ways to play it: Energy Transfer and Williams companies. Walk me through both those.
Yeah, so really quickly on Energy Transfer, it's a master limited partnership, but it owns a really large infrastructure moat of economic assets that it operates. It's really, really diverse in terms of its asset base. Got a really high dividend yield, 7 or 8% these days. It's grown that dividend yield 3 to 5%. It's an investment grade company, just an outstanding company, really trading at a very, very low multiple. And so I think that company, if you're looking for dividends, it's a great place to get invested in.
Williams
Yeah,
companies.
Williams is a natural gas producer. So if you look at where's the energy going to be generated in the future? You mentioned electricity is the new oil. You got to have some fuel supply source. We think that natural gas and nuclear are the future supply sources. You want to own a company like Williams, one of the largest pipeline networks, largest natural gas pipeline networks in the U.S. They're actually building some electricity generation as well to power all of these data centers and this AI boom that's happening as well. And it's got a nice dividend yield to it too, 4 or 5%. It's going to probably grow 5 or 6%, so good opportunity there as well.
What about AI infrastructure? I want to, another theme one we talk a lot about on this show. Seagate Technology would be your pick there?
Yeah, so you're just just talking about, Jared was talking about AI and Nvidia, but what we like to tell people is, the AI it doesn't run on chips alone, it runs on infrastructure. So Nvidia, Google, Meta, all great companies, but there's a lot of infrastructure that's needed as well. So electricity is the new oil, but data is the new oil as well. If you think about what AI needs, it needs more data. Seagate operates these data storage devices. There's millions of them, and there's millions of them in all of these data centers, and there's new data centers being built all over the country. The data centers are getting larger, so they're just going to be adding more and more of these data storage devices, and Seagate's one of the market leaders there.
What's sort of the competitive advantage Seagate has, in your opinion?
Well, they have a technology advantage. Their devices in particular tend to store more data more efficiently, and so it results in being a lower cost really form of data storage. They've got about 40% of the market share, so that always helps. They're expanding their margins. There's just a lot of great things about a lot of data storage companies, including Seagate.
What about Riot Platforms?
Oh, yeah.
That one threw me, Rob.
I'm sure it did.
How did that get in the portfolio?
Okay, so that's a unique story. That's one of the exciting things that's going on. There's just such an insatiable demand for electricity.
Yeah.
So Riot Platforms is known for being a Bitcoin miner. That's probably what you've seen it about. Well, but what's happening is what we think is going to happen is they're actually going to become a data center operator. And so all of these big companies like Google, Meta, Microsoft, they're looking for power supply, right? And Bitcoin miners use a lot of power. So if they can transform the businesses from Bitcoin miners to data center operators, they can get into these long-term contracts with some really great counterparties and really become a new type of business. And so that's how that's what Riot is doing. They've hired a data center specialist basically to build out their data center business. And so it's going to be a totally different company probably 2 or 3 years from now from what it has been in the past.
I tell you, Rob, I did not think we were going to end this segment on Riot Platforms. I did not know that was coming. Rob, great to see you as always.
Thanks,
Thank you, sir. We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.